What's going on, guys? In this video, we're going to be hunting some dividend stocks. The market is down over 20% while I'm recording this, and honestly, this is the best time to start looking for high quality dividend stocks. In a bear market, dividend stocks tend to do better. They're less volatile, and meanwhile, the price is going down. Your dividend yield should be going up, so that should offset your losses. Now, you're going to want to jump on to your favorite stock screener. For me, I'm going to be using stockanalysis.com. You don't have to use that stock screener if you like FinViz or Seeking Alphas, go over there. But I'm going to be using stockanalysis.com. We're under the screeners tab. I'm going to click on stock screeners. Now, keep in mind, if you were to ask me, this is my opinion, I think the market will continue to go down, but don't try to time the bottom of the market. Not financial advice, but dollar cost averaging into stocks or indexes is the best way to win in the long run. If we're looking for dividend stocks, we're not looking for that short-term gain over the next couple of months, but we want to buy and hold over the next several years or even decades. So that should be the goal here. If you want to do something more short-term, definitely not the right video for that, but we're back to the stock screener. Now, there are so many different filters that we could look through, and don't go crazy with this because you're going to be hurting yourself in the long run. You should only have two, maybe three, maybe four filters to narrow the list down by more than enough. So right now we have over 6,000 stocks. So that's obviously way too much. I'm going to jump to popular, and the first thing is let's narrow it down by dividend yield because that's what we're looking for right now. I'm going to go with over 3%. I wouldn't recommend looking over 5 or 10% because you're going to get a lot of garbage stocks that way. That it may say over 10%, but that doesn't mean that they'll actually pay out. There's probably some fundamental problems with those stocks, and you would want to avoid them. I never buy a stock that has a dividend yield over 10% because it's just not sustainable. So keep that in mind. We're looking for sustainability over the next several years. So I think 3% is a great way to start, especially because we've been grinding down in the stock market. So that's what's creating these higher yields. Next is market cap. This is personal preference. I like something that's over $10 billion. Personally, I would never look at something under $1 billion. Maybe you want to go with over $1 billion, but I'm going to stick with over 10 billion. And we knocked the list down to 204 results. That's enough. Realistically, that's enough. It's easy to look through 204 different stocks if you spend a couple of hours or a couple of days on it. But I will add one last filter, and that's going to be PE ratio. So I don't want anything with a super high PE ratio, especially in a bear market. So let's go to under and then 15. And make sure you're under and not over. So you don't want to have a list that's everything over 15. But under 15, now we're down to a little over 100 stocks. And I want to make sure that I'm filtered for the highest market cap down. And I mean, the first several stocks, we all should know: ExxonMobil, JP Morgan, Chevron, Pfizer, and Verizon. I would say these are 5 great dividend stocks where I probably wouldn't have to do much research. Throw my money into these 5 stocks, and chances are I'll probably make a great return over the next decade or so. But we want to look through this list and see what we can find. First, let's start with the bad stocks, the ones that I want you to avoid. And perfect example is, how about this one right here? PBR, a 41% dividend yield. So there's red flags raising right away. So let's take a look at that one. We're going to open a new tab, and we're going to jump over to it. So you may be thinking, wow, 42%. Let's go over to dividends, or 41%, almost 42. And it looks like it just paid out $2.03 on, or it's going to be paying out on July 27th. And it already has an ex-dividend date. So that means that this is in motion and it is going to happen. So maybe thinking, that's amazing. I wish I got in on this. But if we dig a little more into the stock, so keep in mind, a $2, let's just call it 2 to make it easy, a $2 cash payout let's jump back to overview and let's look at the past month. So the past month, which this was announced back on May 25th. So if we go, if we go year to date, May 25th is right about here. So it was $14.55. And now it's all the way down to $11.83. So yeah, that may sound great when it's $14.50 and it says we're going to give a $2 dividend, but now you just lost more than $2 in valuation. So what does that really do for you? So keep that in mind. Just because you're going to get these crazy high payouts doesn't mean it's actually worth it in the long run or even the short run. So right here, it's at a certain price. Let's call it $14. It says we're going to give a $2 dividend. Well, you could expect this stock to more than likely drop at least $2. So you're going to either break even or make nothing on this trade. It's a bad trade. And then on top of that, I don't think they're going to continue to grow at 1,100%. So red flags all over. I would stay away from something like this. I call this a value trap or a yield trap. Just stay away from it. Again, not financial advice, but I think it's pretty good advice. Anyways, now let's look at something that's a little bit better, something more conservative. How about JP Morgan? It's 3.69%. Now, I know no one's jumping for joy at 3.69%. That's a boring dividend yield, but investing is boring, and that's what you want to go for. You want to go for these conservative yields, but that's still a decent amount. Anything over 3% in my books is good. I'll look between 3 and 5%. Maybe I'll go a little bit over 5%, maybe 5.5%. But 3 and 5 to me, that's like the Goldilocks zone. So let's take a look at JP Morgan. We'll open it up. I think we all know what JP Morgan is. It's Chase Bank. Probably most of us watching this has Chase Bank. We'll jump over to dividends. So we got 3.69% yield, a payout less than 30%. That's really good because there's plenty room for growth. And you can see the dividend growth is 18%. So that's a pretty solid dividend growth on top of a nice dividend yield. Now, what's even cooler is if we scroll down, this is all of the dividend payouts every single quarter, but we want to jump down to this right here. So here's the dividend chart, and this shows you all of the dividend payments since 2012. You got nice steady growth. Here's one outlier right here, November 11th. For some reason, it cut its dividend, but then it went right back on track, giving $1 payouts. So this wouldn't be too much of a concern, this one anomaly right here. I don't know exactly what happened on November 11th for Chase, but I'm sure you could look into it and figure out why they had that. Their growth has been positive pretty much the entire time. Sometimes the growth is a little bit higher than others, but nonetheless, it's still a positive uptrend. That's what I'd want to see. I would definitely add this to a list if I were to form some kind of dividend paying portfolio. So let's jump back, and the next one on the list, and I knew it was going to be on the list, is Verizon. This is one of my favorite dividend stocks. So let's open in a new tab and look under the hood. So not only has it really not performed too poorly compared to the market year to date, it's only down 2% instead of 20% like the S&P 500. But then if we also look over the past 5 years, it had a pretty positive uptrend. Over the past 5 years, it's up 12%, which I know that doesn't sound like a lot, but you got to remember it's because we have a very nice dividend yield, 5%. Payout ratio is 49%, which is still good. For those of you asking, really anything under 70% is a good payout ratio. And the dividend growth is very small, but that's okay because its yield is really high. So if you look at its payouts, this is beautiful. This chart right here to me is pure sex. You just see it going up at a nice steady rate, and its growth for really the past 5 years has been pretty steady, around 2% growth. So you know that this is pretty promising. You're going to continue to get this payout, every single quarter. You're making 5% a year on the dividend yield right now. Definitely a top pick for me for dividend stocks. So back in the list, let's find something that's a little less known. So let's scroll down the list and keep in mind our market cap. We're getting down into the sub $50 billion market cap. So these may be companies that we really don't know that much. Phillips 66, I know this company, so I'm going to click on it. We're going to open it up and see what we have here. So I like to check, wow, year to date, it's actually up 16%. That's interesting. Over the past 5 years, it's really not doing much, just kind of chopping around. But let's take a look at its dividend. So a little over 4%, that's really nice. Payout ratio is a little bit higher, but 63% is still below my 70% threshold. And the yield, 3%, it's a modest little yield. Let's scroll down and look at the chart, and you can see that is some really nice growth. We kind of plateaued, but it looks like they recently increased their dividends. But for the past 3 years, they've been paying 90 cents each quarter, and this is the growth. You can see the growth just kind of dropped off, but you're still getting that nice yield. So keep in mind, we are in a bear market, and this stock year to date is up 16%, beating 99% of all the other stocks. And that's how some dividend stocks work. They are defensive stocks. They're going to do well in bear markets. And even not in bear markets, if you are someone that's older and you don't want to throw your money into Tesla or some of these risky stocks, you can see this stock is just kind of bouncing around, not doing much, but you're getting that consistent dividend payout. So I would view this stock almost like a makeshift savings account with a nice APY. You're getting that 4% APY, and the stock is pretty much staying constant over the past several years. Really, over the past, since 2014, 8 years, you've been kind of hugging that $85, $84 price range, and you've had a pretty nice dividend yield the entire time. Now, keep in mind, this is just a single stock. If you put all your money into this thinking this is going to be my savings account, then that's very risky, because what if something does go wrong? Companies belly up out of nowhere. You got to keep that in mind. That's the whole point of diversification. So if you add Phillips, Verizon, and JP Morgan, now you've separated your funds into 3 different companies. You're diversifying. One of them is in the banking industry or finance. The other one is in telecommunications. And then Phillips 66 is energy. So you have 3 different sectors as well. That's also helping you with diversification. But let's try to find another stock. I don't want to keep this video too long, because eventually this stuff should become repetitive, because it's really not that hard. We're going to look at Metlife. So MET, we're going to open in a new link. For those of you wondering, there's another financial services company. So maybe we wouldn't want to go this route. Maybe we want to stick with Chase. Maybe we could have it in 2, but if you want to try finding something in a completely different industry so you're more diversified, then just keep looking down this list, because there are plenty of solid picks here. But let's take a look at MetLife. Let's jump over to the dividend yield. 3% on the smaller side, but still 3% is good. Its payout ratio is very small, and it has a nice little dividend growth. 4% isn't that bad. And if we look at the chart, so it looks like back in 2012, I don't know what happened here, but after this drop off, the dividend yield has been pretty constant for a decent amount of time. We're looking back at 2013, so almost 10 years of solid dividend growth. And this is really nice. So the dividend growth is very stable at around 4%. But one last thing we need to check on with this, how's it doing year to date? Year to date, it's pretty much broke even. That's not bad. Again, compared to the S&P 500, that's down 20%. Don't even get me started with the NASDAQ. That's down over 30%. Over the past 5 years, it's done pretty well. It's up 31%. For a stable dividend stock, a very safe bet, being up 31% over the course of 5 years, that's pretty good. And you can see right here, this pretty much sums up this video. In a sour market, these stocks have been sweet. Definitely MetLife, definitely fill-ups. Again, if we jump over to the past 5 years, or I guess year to date, we should really be looking at 16% year to date, pretty much break even. Verizon year to date, just negative 2%. And if you throw in that dividend, you're actually positive, because now that we're in June, you've been paid out, I think, twice already. Let's see. Yeah, pay date February and May. So you've pretty much made 2.5%. And we're down 2%. So you're breaking even on Verizon. And then JP Morgan, year to date, that's the one that's only down a lot, 27%. That is more than the S&P 500. But this is a mega cap stock, over $300 billion. So honestly, I think that this is a pretty big discount for JP Morgan. So if you're just getting in, this could be a really nice long-term bet, because I would personally see JP Morgan going up. But hey, nothing's too big to fail. We look back to 2008 when plenty of banks went belly up, plenty of big banks that we all know too well. But again, that's the point of diversification. But that is how you could hunt for these stocks with a stock screener. Don't use too many filters. You just want to stick to the basics so you have a big enough list to look through. And guys, I hope you found this video helpful, kind of teach you how to look for these different stocks. And don't forget to smash that like button. And as always, I will see you in the next one.